This is a stock analysis update for IGas. IGas came out with their interim results yesterday, and the share price is now about 15% below before that report came out. I invested in IGas a few weeks ago, and I'm currently about 5% under. So in this update, I'm just going to look at what's the content of that report. But if you haven't seen it, 10 days ago, I did a 54-minute long, extremely detailed video on IGas, so you might want to take a look at that. Before I continue, please remember that I only do these videos as a hobby, and you should always consult a financial advisor before making any investments. So taking a look at their interims, financially they were actually an excellent set of results, and I'll come to that in a moment. Qualitatively, only a few things were different from when I last looked at them 10 days ago. The first thing is that Stephen Bowler, their CEO, is leaving with immediate effect. And they've brought up, and Chris Hopkinson, who only joined the board in January this year, it is now going up as an executive chair role until they get a new CEO. This is discomforting news for me. For the CEO to be shed off so suddenly when the company's doing so well, this puts a big question mark over the company, and this could well explain why the share price has gone down since the interim report. That's obviously kind of an unpredictable thing. It could just be that the major shareholders want someone else in to take the company to the next level. That's how they've been marketing that. But it could also be something really bad that's happened, and there's no way of knowing. So that's a big risk factor that's suddenly added to owning this stock, and which is a surprise as of yesterday. Another new thing that came out is that they're doing some development projects on some of their oil fields. In their interim, they say that they'll add up initially 900 barrels per day, and then eventually 1,400 barrels of oil per day, which is actually quite a substantial increase to their current production. But actually, when I look into it a bit, it will take a few years for that to ramp up. Here's the projects here. It's the Corringham infill drill, the Corringham field, and also they're doing some field extension drilling at their Glentworth field, which is here. But overall, these take a few years to ramp up. So the conservative way of viewing it is that they are maintaining their reserves with these projects, and possibly they could be increasing their daily production a bit and therefore their profits a bit at these new oil prices. But it's not like a massive impact. It's just kind of a positive. It's kind of more like a mild positive for me. Incidentally, while I was looking into that, I discovered that the Welton field, the oil field that they have here, is the second largest oil field in the UK, and the Singleton field and Stockbridge fields are the third and fourth largest oil fields in the UK. So that was just interesting to know. So back to the interims, and there was another bit of new news which was very interesting, and that's where they talk about the shale, how it's great that Liz Truss has now lifted the memorandum on shale. I'll go into the financials, but they actually wrote off some of their shale assets they had at Ellesmere Port. But they actually say that their Gainsborough Trove resources are superior to the Cheshire Basin resources, and they're effectively, in the gist I get, is they're not going to do any fracking in the Cheshire Basin because there was like earthquake problems there. But they're saying that they've got data that the geology of the Gainsborough Trail shows that you can have relatively small earthquake problems, and that they think it's well suited for fracking and natural gas exploitation in the UK. They mentioned some data that they gave to this Dr. Harper back in 2020, which is considered proprietary information. But they say that they've now given that data to the British Geological Survey, And they say that that data demonstrates that they have world-class shale gas resource in the Gainsborough Trowel, and that when compared to other areas of the UK, the geology of the Gainsborough Trowel is much less complex. So they think that with this data, this could help with the regulatory framework that's being set up, that could be very beneficial for IGas to exploit in the Nottinghamshire area where the Gainsborough Trowel exists. So that was a nice extra detail which I found kind of promising, but obviously we're going to have to wait over the course of the next year for the shale gas news flow to start happening. Myself, I'm kind of waiting for the real oil energy crisis to kick in around winter and next year before the government then really starts getting into gear. So that was it for the qualitative side for the interim report. But what was more impactful for me was the financial side, the quantitative side, if you like. And they came out with a real stonking set of results. Their interim revenue was 30 million, which is almost as much as the whole of last year. I see that as they make more profits now, they get more tax credits. I do not, if I'm honest, really understand what's going on with these tax credits, but it does seem that when they're making more revenue, they get more tax credits. If someone could confirm that in the comments, actually, who's an accountant or something, I'd appreciate that. Their DD&A is in line with a similar burn rate from previous years, as is the cost of sales, as are their admin expenses, and as are their finance costs. They had 6.5 million of exploration write-offs related to their Ellesmere Port shale asset. Around here, of course, is where Cordrilla had all the problems with earthquakes, and that's what led to the fracking ban in the first place. So IGas is staying away from there, sticking to the Gainsborough Trowel, where they say they've got superior geology, and so that's why they did this 6.5 million write-off. So the write-offs, though, less than what I was worried it could have been, and they had a 10.5 million impairment reversal back in 2020. They took a 39 million hit or taking on impairments on the value of the oil price because the oil price had crashed. Well, now with increased oil prices, they're reversing some of those impairments, and so that was a benefit to the company. And derivatives was something as you'll see if you look at that 54-minute video I did, derivatives was something I was worried about. Now they're higher, 7.5 million for the interims, so then I've assumed 15 million full year, but not as bad as I thought it might be. So it's quite reasonable for me to then pull out with numbers for full year. Well, I estimate for full year, and the fact is that the interim operating profit and net income are extremely positive compared with what we've had historically and before, and all the data I had up to when I did that video a few weeks ago. These are really positive numbers. Even if I was to assume that they got no tax credits, they'd still be looking at a 8 million net income, and with those poorly understood by me tax credits, they're looking at perhaps up to 20 million of net income at the end of the year. The current oil price situation is transformational for IGas. They've gone from being a zombie company to a company that's now actually bringing in some serious money every year. When I look at the assets, the assets have significantly increased from 68 to 88 million. That is a very large increase. A lot of that is because of the increase in oil price. It means that their oil assets and future earnings of those have increased in value. Now that their share price has dropped, it's gone up since I did this, but when I did this not so long ago, which was only 4p difference in share price, I had a market cap of 88 million, And that means that actually at the current share price, we're looking at parity with their price to book, a price to book ratio of 1.0. Their current, their results that they came out with the other day, it's transformational. Their price to books improved from 1.5 to 1.0, and their net income is, as you can see, the net income story has gone from being seriously in the negative to now they're bringing in some decent money. Their price to earnings are now 11 to 6 to 1, depending on whether you include the tax credits or not. Bear in mind, these are my own calculations, and I'm not an expert, but that's what I've been getting for my own for my own purposes. We've got the very negative news of the CEO suddenly having to clear off, but actually, in terms of their numbers, extremely positive. And this blue line here, this actually represents a price to book of 1 to 1. So overall, obviously the main bulk of investment in this company was based around speculation around shale gas. And the thing to have done would have been last year to have bought, and you could have sold off 3/4 now, even before the fracking starts. You've made a good return based on that speculation. But actually, now that we've got the benefit of their interim results, unless there's something seriously wrong with my analysis here, they seem to now be a money-making oil producer. Things have completely transformed. And on the basis of that, I'd say that their current share price, which is around their price to book, is a fair value for them at worst, with only positive upside based on whatever happens in the future with the fracking. So although I'm currently about 8% down, I'm actually fairly happy now from this level. Having looked at the transformational situation of their profit and loss statement, I think that they're kind of fairly valued at the moment, and I'm quite happy waiting around with any upside being from whatever transpires from the shale gas story. The risks longer term are either what's going on with the CEO leaving quickly, could there be some shock news coming in related to that? And also, if there's like a big stock market crash and recession, that could drop oil price, which could then drop the IGas price. I've got to remember that the whole reason I went into them was for the asymmetrical bet regarding shale. That was why I came in, and so and that's why I also only invested a very small percentage of my overall portfolio into them. And so really that for me is the story. And so, I'd be prepared to take some losses based on the asymmetrical bet reason that I went into in the first place. But actually the results they came out with, in terms of looking at the actual numbers, things are looking actually quite good, better than when I actually first invested in them. So it'll be very interesting to see how this story develops. I thought it was good to do a update as the interims had come out after I'd done a very detailed video on them only 10 days ago. So there you are. Good luck with whatever you're doing and play safe. Please read the disclaimer and remember that prices can go down as well as up.